we can actually ask questions in there, or just stop me. Feel free to shout it out, and we can address them as we go, because it's a lot of information. So I don't want to have you forget, and then by the time we get to the Q&A, well, the question's gone. So feel free to interrupt me is what I'm saying. So we are TrueVeer Financial, okay? And a little disclaimer before we start is we're not here to sell anything or to convince you about any specific product or strategy, right? This is educational. It's for educational purposes, to bring awareness of things that are out there, vehicles we've heard about but may not know much about, and just to have a conversation, or a place where we can have conversations and ask questions about these things. So let's get it going here. And I'll start with who we are, what we stand for. So TrueVeer, we are all about trust. We want to build trust with our clients, and we know that that takes time, takes consistency and honesty, right? We want to nurture relationships with like-minded people, right? You guys are all here because you want to learn, you want to increase your knowledge, and we want to help you increase that knowledge, because we love talking about this stuff. We can talk about this stuff all day, and if it can help you better any part of your life, then absolutely, so be it, right? Now, we like to start with understanding who you are, what stage of life you're in, and where you currently are at with your finances, with your retirement planning, whatever it might be. So we got to understand where the client is before we can make any suggestions, right? Then we're going to basically educate you on several vehicles, different strategies, and just what your options are based on what you've shared with us, right? What we've learned. So we're big on education. That's why we're doing these types of things. Now, the goal is to help you create a roadmap, right? We want to help you lay out a vision for yourself. Once we know where you're at, let's figure out where you want to go and how we can help you get there, right? Or be a part of helping you get there. And of course, integrity is at the heart of everything we do, right? We always want to do right by our clients, always do the right thing. This industry is filled with too many, unfortunately, dishonest people, and we're trying to really flip it on its head and make sure that the client always comes first. And that's why we go through these steps of really figuring out who you are, what you need, before we even talk about any kind of strategy, right? We want to take our time. And our goal is essentially to get you to the aha moment, to where we get you to be like, oh my gosh, like that makes sense. I get it, you know? And that moment's really cool, because you can see it in their face, you can hear it in their voice, and it's just an awesome feeling for us as strategists, as consultants, as coaches, and so that's what we strive for, right? So before we kind of dive into the whole material, I just want to put these thoughts in your head, right? So knowledge is power, right? We've all heard that, and so these are just some details that I personally think anyone should consider before diving into any investment or strategy, or just questions you should ask about any kind of thing you're putting your money into or possibly putting money into, right? So number one, how does it grow? How does it compound? Okay. How does it do that? What entails that? What's the exposure, right? Slash safety. Is it, what's the risk level, right? Is it very safe, guaranteed, or is it very volatile? And, you know, there's huge upside, but there's also a lot of room for downside. Next, how liquid and available is it, right? Is your money locked up once you put it into this thing? Can you access it at any point, right? That's a big question, because if you're putting significant amounts of money, or even any money, right, you want to know if you can access it or not. And then what are the rules? What are the fees? Are there restrictions? How does it affect your taxes, right? These are all things you should have in mind when you're going into something, because they all affect your life, essentially, right? So just going to put those out there as we go through these. Oh, there we go. My clicker's not working. There we go. So first, we're going to get right into talking about money and taxes, okay? Now, there's three ways that your money can grow. And I want to cover the basics here so that if anyone has questions, we can answer these before we dive into each specific product that we're talking about today. So there's the fixed way, right? That means you have a fixed rate of return. So if it's 2%, 3%, whatever it might be, you're not going to get more or less than that. It's fixed, right? It's very stable. It's safe. Next, you have variable. Now, variable, you can think of it as like the stock market, right? It's up one day, it's down the next. There's no real telling what it's going to do, but there's huge upside, right? We've all seen the big plays that some people we know personally probably have made in the stock market by investing. But at the same time, we always hear about people that have lost a lot of money because you also participate in the downside, right? That's the variable aspect of that, as you can see in this graph. And then there's something called the indexed way. Now, indexing is a really interesting strategy, if you will, because basically you have upside potential, as you can see in this graph here, but you have downside protection. Now, that means if the market starts going down, right, you're not going to lose money. And everybody always asks, well, how is that possible? How can you guarantee, or how can you say that I'm not going to lose money if the market goes down? Okay. And simply put, index strategies will guarantee you don't lose money on the downside by basically limiting your upside. So they're going to limit how much you can participate in that upside. So just for easy numbers, the market goes all the way to 25% return that year, and you're capped at 12%. You'll go all the way up to your cap, which is 12%. You get 12%, but then they get the rest, right? Whoever you've allocated your money with, that's putting you into that index strategy. Does that make sense? Somebody give me a thumbs up or give me a yes or no. Because sometimes it sounds too good to be true, right? Like you're going to say, I'm not going to lose money. That's crazy, right? But yeah, so we're going to limit your upside, how much you can grow. That's how we're going to guarantee that you're not going to lose money. Cool. Got some thumbs ups. So we'll move on here with this. So now we're going to talk about the different tax buckets. So these are important to consider, again, because everybody loves taxes. So they're always around us. We can't escape it. So the first one is taxable bucket. Now, these are things like stocks, bonds, mutual funds, your savings account, meaning you pay taxes on the gains made in that year, right? Or if you sell that stock that year, you pay taxes that year. Tax deferred, the middle bucket, means you're going to pay taxes at a later date. So you're deferring it to a later date. That's what most of these traditional retirement plans are, right? Your 401k, your pension plans, IRAs, annuities, you're going to pay taxes at a later date. And then the tax-free bucket is things like your Roth IRA, because it's post-tax dollars, right? You've already paid taxes on the money you're putting into it, so you're not going to have to pay taxes again. 529 plans, which is what we're going to talk about today. And I put the pens in there because it depends, and we'll get into that as we go through the slides here. And cash value life insurance, right? Oh, got a question in the chat here. So with the tax-free, are you paying taxes on capital gains though? So it depends on the vehicle. If it's in a Roth, you won't be paying tax. Like there's certain implications that we'll cover, but for easy purposes, no. As long as you're following the rules of that specific vehicle, you don't pay taxes on the gains, right? And we'll get into more detail with that. So let's see here. Justin, do you want to comment on that?
Yeah, so I think what Tony was asking about. So I think with the tax free, are you paying taxes on capital gains? So I think you might be referring to like the taxable account, where that's where like brokerage accounts where you can invest into it and then you can have upside. And yeah, there's no, if it's inside of that Roth IRA chassis, if it's within those parameters, yeah, it's completely tax free. But I think the only time you do pay capital gains is when it is in a taxable account, like let's say Schwab, Robinhood, or any of those different types of brokerage accounts.
Okay, yeah, that's what I was like. Let's say you have $100,000 that you invested, and then by the time you decide to retire, let's say it's $1 million. So that
Mhm.
100,000 to $1 million that you gain based on what it was invested in when you are ready to retire, are you paying taxes on that?
Yeah, if it's inside a Roth IRA, no. But if it's in a taxable brokerage account, then yes, if you are
Hmm.
selling and withdrawing out, yeah. And then
Right.
that's
Right.
where like, I
Great
mean, not
question.
to get, yeah, not to get too far into it, but that's where like even with the brokerage accounts, you can even borrow against those, right? Where it's like,
Right.
like 50% loan to value. But again, that's where it's non-taxable as well. But if you do sell, it is taxable.
Yeah. Yeah.
Yeah.
Great question. Thank you, Justin. All right. So now different vehicles, different strategies. Now, our big thing is we're not going to push one single thing on you or say that one single thing is the greatest thing ever, right? Because we're all about diversifying your assets. You're building your portfolio, but we just want to do it strategically. Now, in this instance, we're talking about picking a vehicle that's right for your kids' savings plans, right? Whether it's for college, whether it's for helping them buy a house later in life, whatever it might be. And there's different ways of going about it. So none of these are wrong, right? They're just different. And so we just got to understand what each of these different strategies mean in the context of everything we talked about, right? So look at for the first person, right? They have a 529 plan for their kid. They started it when the baby was born. Awesome. And they're gonna rely on their savings accounts. Nothing wrong with that. Then we have someone with a savings account and they got a 401k, right? They didn't start the 529, no worries. They can borrow out of their 401k. They can liquidate that if they want, whatever they want to do, right? But there's rules, implications, and everything that you have to consider. It's just different. And then the one we're going to talk about today is cash value life insurance and a 529 plan, how they kind of work together, similarities, differences, and if one, the other, or both might be right for what you're trying to do. Because each vehicle is like a tool, right? And each tool performs a different job. So just got to make sure you have the right tool for the right job. So we'll start with the 529 plan. And this is where let's feel free to ask questions. We're going to go through the benefits first, and then we're going to have some considerations. Because I don't like to say cons. Sounds like I'm talking bad about it. It's just things you should consider. It's things you should know about, right? So we'll start at the top here with first benefit with the 529 plan. It is a market-based growth vehicle. So it grows with the market. The market is doing really good. There's a potential to capitalize on that growth, okay? Now it grows tax deferred because there's other rules that dictate if it's going to be tax-free or tax deferred. Now, it'll be tax-free withdrawals, right? You can take money out tax-free if it's for qualified education expenses. So this is a vehicle based around education. So that means when you do use the money that you put in, or the money that you earned within it, it has to be for a specific qualified educational purpose. Okay. Now, another good benefit is that it has a high contribution capacity. So if you got grandparents that want to dump a lot of money into it, those are great people to have around for something like this. And it holds a lot, right? There's a very high limit. And it varies by state. I think in California, it's something right around like 500,000 is what we were looking at. Okay. And another cool feature this has is the beneficiary, meaning the child, right, can be reassigned to a different eligible family member. Now, let me tell you this. You have to sit down with a qualified planner that sets these things up to know those specific rules and regulations, right? But I'm just giving you the overall gist of this. So this is not something that we can set up for you, though I can connect you with someone. I do have contacts that do this for people, but beneficiaries can be reassigned. There's just specifics to it, okay? and everybody's situation is different. So just want to throw that out there. Now, considerations. There's market risk exposure, right? So that means that while they can take advantage of the upside, it can also fall when the market goes down. So typically a 529, you're gonna have for, you know, if you started from when the baby's born to when they're gonna start college, you got about 18 years. So you got some time for the market to go up and down and kind of just endure those low and high points, right? But there's specific safeties that you can do, basically, like as you get closer to needing the money, you have the person who set it up, your advisor, check in with you as it gets closer, and they start basically switching the investment strategy to a more conservative strategy, right? So they're more aggressive with it in the beginning, but then as it gets closer to the time when you need the money, that the kid's going to go to college or whatever, they start being more conservative. So it's more steady, and you don't have these crazy dips right before you need the money, right? So there are use restrictions and penalties for non-qualified uses. So this kind of falls into the liquidity aspect of it, right? Like it is for qualified educational purposes, but that doesn't mean if you had a total emergency, you couldn't dip into it. But it's kind of like dipping into a 401k. You're going to have a 10% penalty, and you're going to pay taxes if it's not a qualified educational expense, right? So another thing to consider. Timing risk, this is what I was kind of talking about, where you have to meet with your advisor, and you have to have someone who is going to disclose that to you and not just set you up and leave you in the dust, right? You have to be with someone who's going to check in on you and be like, hey, we need to get together, because this is almost to this point where you're going to start making withdrawals. What's going on, right? You want someone looking out for you so that the investment strategies can be changed according to where you are in the timeline, okay? So there is less flexibility for non-educational uses. Like, it's not to say you can't dip into it, like I said, but there are those fees and penalties. So you gotta understand that part. Now, another cool thing you can do with this is you can convert this to a Roth IRA. So if it's like maybe an only child, right, there is the option to, meaning they can't pass it on to another qualified member. They can go ahead and convert this to a Roth IRA and start basically building up for retirement that way. Now, again, there's flexibility with that. There's rules with that. So you have to talk to the advisor, and they got to look at your specific situation. Okay. That was a lot. Any questions, clarifications that you would like? Anybody? I'm gonna take a drink of water. These allergies have my throat really dry. If no, somebody give me a thumbs up. Going once, going twice. All right, thank you, Tim. All right, perfect. So now let's talk about a custodial Roth IRA. So this is slightly different than a regular Roth IRA, because the Roth IRA you and I can go set up because we're employed adults, right? A custodial Roth IRA is a little bit different because this is something you can set up for your child, but there are specifics to it. It's not, you can't set it up from, birth. Your kid has to have some sort of actual income. So let's go through the benefits first. So there's market-based growth potential, so it can go up, right? It can also go down. That's one of the considerations. And the growth is tax-free, like in a Roth IRA. Okay. Now, contributions, meaning the money you put in, you can access without penalty or tax, because that's your principal. Okay. The money you earn within it, that has some restrictions, if you will. We'll get on that on the other side. Now, there is investment flexibility, meaning that the money that you put in, you have a variety of choices of where you want to invest it. So you can do mutual funds, ETFs, index funds, right? You have the ability to be a little more customizable with it, okay? And it's a parent-controlled vehicle until the child becomes an adult. Okay, I gotta move this thing. It's in my area here. Okay. Now, some considerations, like I said, it is exposed to the market. So again, any kind of retirement vehicle, you're going to see it's going to go up and down because it's meant to be a long-term play, right? You're not going to set it up one day and then take it out next month, right? So there is that market risk exposure you have to be aware of. Now, the child must have legitimate income, right? So it can't be just like, oh yeah, I totally pay my kid, and then you're just dumping money into this thing, right? And they don't even know about it. It has to be like a W-2 job, or if you have a family business, that's a cool way to basically pay your child, start something for their retirement now, and it's a tax advantage for the business. So that's another cool feature. Now, there are annual contribution limits that apply just like in a regular Roth, and the child does gain full ownership as soon as they become a legal adult. Okay, and then same as a regular Roth, the earnings are subject to Roth IRA rules, meaning if you access before 59.5, there are those fees and tax implications that come with it. Okay. So that's custodial Roth IRAs. That was just to build off of what you could turn your 529 plan into or set up if you have like a family business or a child that's starting to work, right? Just another option to get a kickstart, because it's never, you don't worry about what you couldn't do. You worry about where you're at now and what can be done, right? So any questions on that one, type them in the chat or
So would that
shout them
be,
out.
sorry, so would that be beneficial to roll a 529? Because isn't a 529 more for like college and stuff? So like, let's say they don't decide to go to college or whatever, then you can just roll it over into a custodial IRA?
So depending on the age of the child, it wouldn't be custodial. It could very well just be a regular Roth, right? Custodial, that I understand the slight confusion there. It can just turn right into a Roth, especially if they're already of age. But yeah, like you said, it just depends on what you deem more fit. What age is considered adulthood, LOBA, legal? So it would be age 18. Yeah. Good questions.
Thank you.
Anybody else? I'm like scanning your guys' pictures here, making sure I don't miss any thumbs up or anything, but okay, cool. So now we'll move on to the cash value life insurance, which the one we're going to talk about today is indexed universal life insurance. So again, stop me if this becomes confusing, because it's a lot. So we'll start with the benefits. So indexed universal life will be tax-free growth. Okay, the money that accumulates within it is tax-free. It has market indexed linked upside. So this is very important to understand. Market linked does not mean your money is put into the market, okay? So it's just linked to a compilation of stocks, which is what an index, or what the index is, right? So like the S&P 500 is an index. And if we link our growth to that index, we're gonna grow based on how that specific compilation of stocks and companies performs. Okay, let me know if that makes sense. You're not putting your money in the market. You're kind of just tying your growth to how the market is doing, but you're never putting your money in it. Okay. And because it's an index strategy, if you guys remember, there is going to be that market downturn protection. So they're going to limit how much you can earn, and each carrier varies, right? Typically, everybody that talks about IULs is going to say right around 12%, but some of the carriers we work with is a bit higher, and we've seen higher, but it's just 12 is pretty industry standard, I guess. So you have upside potential, you have downturn protection. So that's a cool benefit. Now, permanent protection and living benefits. So because it is life insurance, you are going to have a death benefit attached to it. It's an insurance product, a life insurance product. So that's your permanent protection. I need some water. Okay, so never a bad thing to have that permanent protection looming over you, especially as you start aging and you go through life. And I can't tell you how many people I talk to in their 30s, 40s that never set it up, right? But they built families, they built all these different things, and having that protection just looming over you or just having your back is definitely a great benefit. Now, with the permanent protection, these types of policies come with living benefits. Now, living benefits basically means whatever amount of death benefit insurance you have, if you happen to fall ill, or there's some sort of terminal illness, or there's some sort of, disability that is covered and happens, God forbid anything like that ever happens, you're able to access some of that death benefit while you're still alive to pay for medical expenses and anything like that. So that's a pretty, you don't have to be old to get sick. And I don't want to get morbid because this is, for kids and stuff like that. But the point is, you have protection. You don't just pay a cost and get nothing in return, right? Okay, I see something in the chat. Let's see. Which is so much better than the current CD of maybe 3%. Yeah, absolutely. I hear you on that. Okay, any questions on the permanent protection and living benefits? Living benefits is one of those things that, there's usually a couple questions about it. I'll give you guys a couple seconds to think about that or say something about it. Okay. Nada.
So when it comes to like living benefits, you know how there's like, what is that, when it has to go through the state for like gift taxes or anything like that? Are you susceptible to that when you have that person as your beneficial for your life insurance?
So meaning, like if you had one of these for your child or if you had one of these for yourself? I don't know if I'm understanding your question.
So let's say I have this, right? And I don't know, I pass away for something. Yeah. And I have my my beneficiary. Are they gonna have to go through probate and pay taxes for it, whether I have a will or not?
Yes. So no, not with the death benefit on these types of products, because that's one of the benefits that's actually within the IRS guidelines, that life insurance death benefits are not subject to taxation. They pass on tax-free. Great question. Yeah, you don't want to be paying money or like leaving a bill, big bill for your beneficiaries when the time comes, right? Yes, DD, if it goes to probate, absolutely. Thank you. Justin, you had a comment?
Yeah, I think a big benefit, I mean, I know you talked about it briefly, is just, and we like to talk about a lot of basically the cash accumulation and the leveraging and all of those different components of the IUL. But I think I said this maybe a couple of sessions back, but I think something we kind of overlook sometimes is the living benefits. So like God forbid something happens, you can't perform two of the six daily living activities or activities of daily living, right? You can actually have an advance of your death benefit. So you can access
Yeah.
those living benefits. So I think that's something that's kind of overlooked because we tend to use that insurance wrapper as a tax benefit. But I think also there's also the other components to it where you actually do have those living benefits attached to it as well, which is, the critical chronic terminal illness benefits. So I think those are super important to have. I mean, just having a conversation, right, about, HSAs or things like that, which is also another underrated account. But even with this,
Mhm.
like this is kind of your own version of an HSA where you can access that advancement of the death benefit. So that's just some comments, some thinking out loud on some of these benefits on the IUL side.
Yeah,
I'm just,
absolutely.
a lot of the questions
Definitely.
I'm asking is just because, when you're trying to, whether you make money that puts you in another tax bracket or you maybe don't make that much money, but still a lot of your money is going to the taxes that you have to pay, just trying to see like how can you leverage your money so that you're not having to pay as much taxes, and then if something should happen to you, how can your family members or whoever your beneficiary is, if it's not a family member, how they can also avoid paying extra taxes on stuff because they got this amount of money from God forbid you passing away, and now they're in another tax
Hmm.
bracket and they don't know how to manage that money so that they're not having to pay a bunch of taxes on it.
Yeah, no, absolutely. And that's a huge thing that I think a lot of people miss. So it's definitely, it's good questions because it's good things to be aware of, especially because that's just a fact of life that people don't like to talk about, but also don't maybe know about, right? Let's see, we got a couple of things in the chat here. So Dee Dee said, can I make my trust a beneficiary? Absolutely. And so that's one of the great things great strategies, right? You can definitely have the trust be the beneficiary, and then that'll dictate how the money is handled, especially if you want to divvy it up in certain ways, right? For sure. And then Steve, senior care can be costly, 10K a month or more. Absolutely. Yeah, it's no joke. I mean, we've either all know someone personally or have experienced it ourselves, right?
Yeah.
So great. You guys see the benefits of that for sure.
No, I have friends that
Uh,
are like investing in care homes so that way
mm,
they can put their parents in that care home because they have partial ownership in it so that they don't have to pay the ridiculous prices for care homes.
yeah, that's crazy. I mean, hey, if you got the means for that, that's awesome. But yeah, it's, not everyone can do that. So the majority, it's just out of pocket, or if you set something up, great, but still, it's not cheap. That's the reality of it. Okay, so let's move it on to flexible access for future needs. So via cash value loans. If some of you have been on here before, you've heard us talk about infinite banking. You literally using the cash value that accumulates within these policies as collateral. So you go to the insurance company and say, hey, I have this much money. I say I have 100,000. I need 20. Give me a loan for 20. And they say, okay, yeah, you have $100,000 worth of cash value. We'll give you 20 at like 5% or whatever it is, right? And we'll get into the details of that specific cycle and process on the next few slides. But essentially, you have more flexibility, and there's no restrictions on what you can use it for, right? So you can use it for business endeavors. You can use it for emergencies. You can use it as your kids' college account. When we've had a couple of case studies, if some of you have been on, where that's exactly what they did. They used one of these policies in order to basically fund their kids' college and put money away and accumulate. as it's being used, right? And I'll get into that in the next slide, in the next few slides. So let's talk about some considerations. Of course, you got to be fair. Got to talk about everything has to have the considerations, right? There is the cost of insurance, right? Now this varies by the build of the policy as well as your health. So when you apply for one of these things, you're going to go through medical underwriting of a certain extent, right? Depending on the amount. But if you have significant coverage for your family, you're gonna have to go through, I don't want to say extensive, but it can be a lengthy process. So if you're in great health, which most kids are, right, it's a fast way to just get approved. And if you get it for a child that is under the age of 18, there are no medical underwriting. There's no medical like deep dive. They just look at the general health of the child's history from their doctor, and if there's nothing crazy, right, like they don't have some illness or some crazy disease, then you're pretty much guaranteed, and you can get them covered. Now, you do want to reassess at. We were having a conversation about this. You do want to reassess or have the underwriting happen when they turn 18, because there's been points where they can be in really, really great shape, and that'll work to their benefit to make their cost of insurance even lower, right? And so that's the essence of setting these things up for people, is we set the cost to the absolute bare minimum in order for the money you're putting in to go towards the cash accumulation part, right? Because we don't want the cost of insurance to be eating up all your contributions, right? And so that's actually why you want someone who's looking out for you, someone who's investing their time and their care into setting you up correctly, because this industry is notorious for agents basically increasing and inflating the cost of insurance super high past necessary points into unnecessary amounts in order to get a bigger payday, right? So it's hugely important that you get with someone who is looking out for you. That's my point to that. Okay. Now with IULs, early liquidity might be limited. Okay. It depends on how much money you initially put in. If you're starting from scratch, from zero, you're not going to have liquidity for those first few years, especially if you're only putting in like $100 to $300. Okay. That's just the reality of it. There's more costs up front, but the costs decrease over time, and therefore your liquidity increases over time. It's just like when you are paying off your home, right? That payment schedule that's set up is taken into account a lot of the interest first, and then you start building equity and the interest lessens as you go, okay? So early liquidity might not be there, but it increases over time. It's a long-term play. That's why if you start it when the kid is 1 or less than 1, right? I think they have to be like 30 or 60 days, right? You just have to have a birth certificate. You have a lot more time for compounding and growing than if you start it when they're already like 18 or our age, right? So that's one thing to keep in mind. And of course, like I said before, it requires proper structuring, meaning low cost of insurance for you, and periodic review, right? We are always after our clients to make sure that they know what's going on with their policy, and we know that they're not just pulling loans out willy-nilly and not paying them back, right? We were having a whole conversation about this, about being a good steward. And so we're after our clients because we care about our clients, right? It's like your parents, if they were always on you, like, what are you doing? What the heck are you doing? It's like, it's because they care about you, right? If they didn't care, they wouldn't ask. And that's how a lot of advisors tend to be. Not us. We're gonna be bugging you. Okay. Now, performance depends on design and funding. That's just kind of echoing, right? If the cost is too high, it's not going to perform as well as it could as if the cost was the absolute bare minimum. And how much you put in is definitely going to dictate how much it accumulates, right? Because a certain percentage of a smaller figure is less than that same percentage of a bigger figure, right? that make sense? Hit me with some clarification over here. Okay, Tawana, thank you. Anybody? Loba, Kalika, Michael? I'm going to leave your questions unanswered. All right, cool. So I kind of wanted to, some of you have seen this before, and basically I want to show you a strategy that utilizes cash value life insurance that is different from maybe using it as your kid's savings account, right? But that is used every day by the very institution that we're taught to put our money into, okay? So this is called bank-owned life insurance. Now, banks leverage cash value life insurance by basically going through this process, right? We deposit our money and they promise us a very, very, very small return that's pretty insignificant for keeping it in there, right? Then they're going to take that money and they're going to put some into reserves, right? Because everyone should have reserves. And then they're going to lend the rest out in the form of loans, car loans, house loans, whatever, personal loans, right? Consolidation loans, all types of loans. They loan the money out at very high APRs and they pocket that interest, right? And that increases their reserves. So after, they can take that money they made and basically use some of those reserves to buy permanent life insurance. Now they buy permanent life insurance on key executives, CEOs, COOs, CFOs, right? People very high up in the company that they can basically use the policy to pay employee benefits. They can take advantage of the tax-free cash growth that happens in these policies, right? And essentially, they're lowering the cost of having that employee in the long run because since it's life insurance, when that employee passes away, the bank is the beneficiary and they get the death benefit to increase their reserves and therefore their liquidity. Now, it sounds kind of like, I guess, messed up. There's different ones that you can do, but this is a very real strategy that banks use to increase their cash reserves, right? And it's not to say like that's an evil thing because they're still being able to pay that person bonuses and a good salary and benefits and all that. So, you know, I'm not trying to say it's like an evil thing, but the reality is when that person passes, that money gets paid to the beneficiary, which is the bank, okay? Because it's bank owned. And then just to kind of show you exactly around how much money the banks have invested into this asset, right? Because life insurance, cash value life insurance is an asset because it's accumulating and growing in value, right? You guys can just take a look. You probably bank with one of these banks and they got a good amount of money into cash value life insurance. And this was as of last year. Should update this one. It's probably bigger right now if you go and look at it. Okay. So just to kind of echo, like, okay, this is being done. You can do this at a different scale, but you can pick the beneficiary so it's, you know, a good benefit for your family. You can put it in a trust, et cetera, et cetera. So again, different strategies, different vehicles. You gotta talk to someone about this stuff. And they do this because life insurance is in the IRS tax code, and it's defined, basically it defines all the benefits that life insurance has. So the tax-free policy, the tax-free death benefit, the way it grows, things like that, they're all in the IRS guidelines. So you're not doing anything shady. You're just working within the rules that have been set, right? I like to call it the rule book of money. That's what the IRS tax code is, what we can and can't do. And this is just a visual of why something like this is a great it's a great hedge against inflation, right? So this graph right here shows the green line is the max funded IUL starting at 100K, the 12% cap, okay? And then the bottom here is the growth of the S&P 500. So you can follow the line as it goes up and down, right? But at those points where it starts going down, you can see it stays steady. And then as it starts going up, it'll also go up. So you never take part in the downfall of the market, which is, I think, a great thing, right? Because you drop that much down, well, you got a long way to go before you were close to where you were at one point. And the other thing to consider is, well, since you're not losing money, you can still, and you're staying at that top number, you can still access the money via loans, right? And that's what we're going to talk about on the next slide. But it's a great hedge. It's a great strategy, a great tool to put into your portfolio, right? It's not to say that this is better than the S&P. It's not to say this is better than X, Y, and Z, right? It's just another tool. And that's what we're trying to make you guys aware of. And let's see here. Okay, so utilizing your cash value. So just kind of reiterate here, the cash value policies, there's a cost of insurance that you pay. And then let's just say you're paying $500 into it, right? The cost can be, let's just say $200. Again, those are just not real numbers. We got to look at specific illustrations to get real numbers. But let's say 200 of it's going to the cost of insurance because you wanted a good amount of death benefit. And then the excess 300 is going into your cash value. Now, every month you're paying that, every month it's accumulating. And then every year, right, you're growing based on the index allocations that you have. So you're increasing your principal and then you're making money on your principal via the market index. So you can use that cash value, like I said, as a form of collateral. So you're going to leverage your cash value that's growing and compounding, and you're going to go ahead and ask for a loan. Sorry, let me move this thing. It's in my way. I know you guys can't see it, but okay, there we go. So yeah, you're going to take a loan out against your cash value, and they're going to charge you anywhere from 2 to 5%. There's no credit checks. There's no question as to what you're going to do with it. You do whatever you want with it. You know, go blow it in Vegas if you want, but don't do that. I'm just kidding. Don't do that. But for like opportunities for your kids' education, you're going to take out a loan. And the cool thing is here, because it's a loan that you took out against your policy, that money never left the policy, right? They just looked at the number and said, okay, yeah, you have the money, so we'll front you this money. So the policy is untouched. It just continues to grow and compound as you took out a chunk of money to use for whatever it is you needed to use. So, I mean, if you're investing, if you're doing like real estate flips, or if you're doing like car flips, right? This is an awesome tool because you can use your money, but you're not really taking it out, right? You just pay a small percentage fee, but if your turnaround is less than a year, well, you're not paying that full fee, right? So there's also payback flexibility, which means that you don't have a payment schedule set up for you. Now, we always encourage people and our clients to basically have some kind of payment schedule planned out, right? This isn't free money. You're taking a loan out against your money, yes, but that doesn't mean you don't ever have to pay it back or should pay it back, because you should be a good steward of your money, right? We're becoming our own bank, and we always want to put money in the bank. So we always want to reduce those loans to keep our liquidity high for more opportunities, right? We really want to emphasize that. We don't condone taking out money and not having a plan, right? Because then you can risk your policy lapsing. You can risk basically the policy just getting all messed up because you took out too much money and now the interest is eating it up and you're not paying anything back, and it's just this whole mess, right? It would just insane. if you pay the banks back with interest, you got to pay yourself back with interest. Absolutely. Justin hates banks, so, don't get him talking about banks, but absolutely. If you're paying the bank all that interest, pay yourself back, right? Increase your liquidity. Like, this is a real system that we teach. So we're very much emphasizing that part. Juana said, is there an average interest when you borrow against your policy? So we like to say like 5%, and it can vary by carrier. There's quite a number of carriers, but yeah, just take probably like 5% as a good rule of thumb.
Yeah.
Okay.
Just to
yeah, go for it.
comment on that. So like there's a lot of like I guess gray area with this because with an IUL, let's say, like with the carriers we use, the max they charge you at if you take an index loan is 5%. So that's the max they can charge you. But if the index is performing at 9, 10, 11, so even like I just looked at some interest rates just today, some are at 17%, some are at 9%, 12%, right? And so the thing is you make that positive spread, right? So that you don't have to worry about that interest. However, let's say there's another type of loan within the IUL where you have a fixed loan. Well, where they charge you 2%, but they'll also credit you 2%, so it becomes a wash, right? And so that's where it's like it's a no cost loan and it's completely tax free. The only thing with that is it does dip into your principal. So
Right.
let's say you did have 100,000, you decided to take a $20,000 loan at a fixed interest. So then yes, that lowers your interest earning potential to 80. So now if you do take the index loan, you borrow the 20, it's still going to earn as if it's 100. Right. So that's the difference between the two loans with IUL. But yeah, like for us, we would like to say if you're borrowing from an IUL, it's usually 5. And then if you have the upside potential, so the max you'll pay is 5, but if you have the index earning 9, 10, 11, 12%, you make that positive spread. Yeah, so
absolutely.
Yeah.
Thank you, Justin. And then, so we just keep that cycle going, right? Like we pay ourselves back, replenish the capital, increase our liquidity, and just rinse and repeat, right? So I think we're doing another case study one soon, but you guys should join to have Justin break that down specifically, like actual case studies of clients doing this. But we do this for, real estate, different investments. Justin, you should actually, not right now, but like talk about we should do one on the credit card payments and all that you do. So we should for sure talk about that. But anyways, the point is you can utilize that cash value. So you're using your life insurance policy while you're alive for different opportunities, right? And there's no restrictions, no credit checks. The loans don't affect your credit. That's another big question that comes up. And so it's a very versatile and interesting tool. Okay. And then, we're all about maximizing your dollars. So essentially, this is just talking about what we just talked about. If you have $100,000 sitting in your savings account, and you need $50,000 for tuition, for emergencies, for a real estate deal, whatever, you're going to Vegas, $50,000. Well, you take that money out, you're left with $50,000, right? That 50 is gone. But if you have $100,000 in your policy and you take that same 50 in the form of a loan against your policy cash value, well, your value in that policy is still earning at $100,000, which, like we said before, earning interest on 100 is different than earning interest on a lower figure, right? So you maintain that higher figure that you were at by borrowing against it. Okay. And then that's basically it, guys. So, the best time to plant a tree was 20 years ago. The next best time is now. Don't worry about what you didn't do, what you didn't know before all this, right? Just take the initiative and set up a time to talk with someone. And we're not going to pressure you. It's just to have a conversation, to throw ideas back and forth. I mean, we've had conversations with clients like 7, 8, 9 times before they feel confident enough to do anything, right? Because it takes a lot of time to understand and to ask your questions. But the point is you have to take initiative and start now, right? Tomorrow is never promised. You got to start now. Let's see. We got another one. One said, I'm all about trying to not pay interest if you don't have to, but I'm also a banker for small businesses and I'm all about leveraging your money. Absolutely. Absolutely. Very well said. And with that, here's some recommended resources. You guys can snap a picture of this, or we can send you guys the recording, but we want you to not just take our word for it. We want you to do some research. We want you to ask questions. We want you to question all these things that we're talking about so that you can be sure that you understand, right? If you just take anyone's word for anything, well, I don't know. So do some due diligence. We're more than happy to recommend different YouTube videos, different resources, right? These are just some books that talk about the things that we talked about today. And yeah, this is just another snapshot of our services. We do a lot of different services, right? So, I mean, I'm reading through a couple of these. I didn't know which one to pick, but we work with tax professionals. We have lending partners, debt solutions, things like that, long-term care. And so just have a conversation with any one of us. We're more than happy to listen and just see if there's anything we can do. And if there's not, well, we'll tell you that too, right? We like to be honest, integrity. So that's it. Any final questions, comments? We're just a few minutes over, so just where I like to be. I'll give it a couple seconds. If I don't hear anyone, you'll have to get us next week. No. Justin, any final words before we wrap it up here?
Yeah, I just appreciate everyone hopping on. I think the importance of having these weekly is to, one, just give back to our community. And if you guys know anyone that would love to hop on these seminars, we're going over different topics every single week, right? Any specifics when it comes to annuities, and even in conversation, right, with some of the guests here, even bringing up some other types of accounts with like HSAs, which is another huge account as well too, right? So I think we have these weekly, and it's really just to provide value to our clientele, not only just our clientele, but also anyone who's open to the information. I think the main thing is, like I said, we want to educate, and we want to provide as much clarity for making any other type of financial decision. So again, and really, like, I mean, Saul kind of touched on it, but again, it's really like, becoming your own bank, or utilizing alternatives and being open to the fact that there's other alternative vehicles out there that can get you to where you want to go, at the same time protect your family as well. So that's really just some of my comments. Like I said, always feel free to invite anyone to these webinars. I think next week, I believe, we'll be covering the types of annuities, right? So whether if it's fixed annuities, multi-year guaranteed annuities, indexed annuities, right? So annuities are a form of a pension. So if you see a lot of pension plans, they're kind of built around that annuity chassis, where it's guaranteed lifetime income. So yeah, that's kind of just what I wanted to, comment on. Always feel free to invite someone. I know we have some people, like Linda. We have some people out in Hawaii, and then also Didi, Auntie D, is also going to be living in Hawaii, right? So maybe you guys can connect. But yeah, like I said, always feel free to, reach out. Always feel free to invite people to these weekly webinars. We have them every Wednesday. So, all right,
you
you
guys
guys.
can just send out that email, the link. Just text it to your friend, whoever you think is going to benefit from it, and they can register. It's the same link every week, I believe. And then lastly, I just wanted to say, if there is a topic you guys want to cover, or something you're curious about, let us know, because we don't know what you guys don't know. And if there's something specific that we can touch on and bring you more clarity, then absolutely, we would love that. Right. So,
Yeah,
yeah.
we
Thank
might
you,
even
everybody.
yeah, we might even email out a survey on what's on some things that you guys might want to learn about, and we can go into the
Yeah.
specifics. So yeah,
Awesome. Thank you, guys. Have a great night.
cool.
Stay
Thank you
safe.
so much.
Peace.
Peace.